Okay, in this video, we're going to talk about the continuation breakout trades. So there's been some good continuation breakout trades, but then there's been a few others that have been head fakes or false breakouts. So obviously there's a way to trade. We're looking at the pound dollar, and this is a 1 hour time frame. There's a way to trade, off of these little bounces here. Sometimes price will hit the support on the number, and sometimes it'll fall just short of it and still work. Either way, we're not really talking about the bounce and the move right into resistance. What I'm talking about is when it finally breaks out of a consolidation range. So in this type of market environment where we're seeing daily, I'm sorry, well, daily too, but the 1 hour time frames and the 1 hour bars exceed the normal or typical distance that it would trade in a normal environment, so like sometimes twice the size. So let's say a normal 1 hour candle would be anywhere from about 40 to 50 pips, for example. Today, what we're seeing in many instances, and not always, but in many instances and during certain circumstances, different cycles or different sessions, that range will be maybe 100, 110, maybe even larger in a 1 hour candle. So when price finally comes back up here and reaches this resistance level and closes above this is last week's high just before the market settled. So with a continuation breakout trade, I'm always looking for specific highs and lows. Uh, Often I would prefer to use or trade off of, if I'm going to trade a reversal, I would trade off of a horizontal support or resistance line that has been tested multiple times. In the situation or in a case where I'm looking for a continuation breakout trade, it's incorporating the actual spike high or the low. So very often that resistance line that helps me identify the continuation breakout trade, that is a result of the the actual spike, not multiple touches of that support or resistance. So there's two different ways I'm using support and resistance. Now I've talked about this many times. You can find the discussion about how I use support and resistance to determine what strategy to use, whether it's a breakout and expecting price to continue in the direction of the breakout or a full-on reversal at that resistance point. The discussion on how I use those support and resistance levels are in the online course. So there's a specific section for that. You can find it in the online course. But what we're going to talk about again today is the continuation breakout trade. Yesterday we talked about the London breakout strategy. Again, today the London breakout strategy worked just fine. But this is the continuation breakout trade. Well, sometimes, depending on the structure, it's going to change the distance of support and resistance just because that's the conditions. That's the current market environment that we're trading in. So you'll notice that this resistance point here is 1.1934 and the low is 1.1413. That's a huge difference distance. That isn't typical. Normally, when I find, let's say, last week's low and then a significant spike high just before the market, like what you see here, this structure would be much, much smaller, maybe 80 pips, maybe 90 pips, maybe 110 pips. And then I wait for a 1 hour candle to close above that range. So the strategy and the overall technique and the structure of the strategy is still the same as I describe it here. It's just that in this current environment, the distances, the same basic price structure, but the distance is much, much greater. So we have to take that into consideration. So what I want to talk about, though, specifically is when I get a signal, regardless of where or how far the support and resistance are, when I accurately find resistance and support that would determine a breakout and then allow me to confirm the breakout with these indicators to know whether or not it's going to continue in the direction of the breakout or not, again, the signal candle is not, once it finally breaks out of that range. Again, I'm using this on a 1 hour time frame if I'm going to day trade it, and I do not use it on a 30-minute chart. That's too small and it will lead to head fakes. But this is a 1 hour chart. This is pound dollar. So we had a continuation breakout trade this morning. It was right here. And on that signal candle, this is actually the signal candle when it's closed, completed. That's what I'm looking for. I do not want to analyze or assess the conditions or assess the possibilities of this trade continuing higher when it's an open live candle. It has to be a closed completed candle. And then I look at the indicators to determine if I've got a valid trade. So you can see here on that closed completed green candle that closed above that resistance, everything looked perfect. The Bollinger Bands were separating away from each other the way they're supposed to. No divergence in the CCI, no divergence in the MACD. So I would expect that this is a perfect continuation breakout trade. This is the signal candle. This is not my entry. This is what would happen when I first developed this method. So there was a lot of testing that I did on my own when I figured out this method. So what I would do initially when I got a continuation signal candle like this is what it would look like. This would be my signal. See if I can get it right there. Sorry, I can't lock it in right there, but that's the signal. Initially, when I figured out what is consolidation and I was able to quantify it, like to put a specific number of hours to it, specific highs and lows, the distance from the high and the low of consolidation has to be a certain range. That's what I used. That was the data that I used to be able to determine if and when I get a breakout candle, is it likely to go to that 55 pip target? Well, once I had that all figured out, I then, of course, needed to test out the 30-minute chart versus the 1 hour chart. I talked about that. You've probably heard me talk about that. And then this is my signal. So initially, I didn't use a specific entry. I would just get in when the candle closed above this resistance, and I would say, okay, that's it. That's my signal. That's my entry. So where that candle closed right there at 1.1971, that was my entry. Now, when and again, this was a lot of testing. This was testing going forward with with real money, with my live account. So then I would end up in situations like this where price would turn around and roll right back down inside a consolidation. And I'll take this out a couple of candles and you can see exactly what it did. So then I was thinking, I was assessing and reviewing my trades, and I was thinking, okay, how can I avoid these head fakes? I hated head fakes. One of the first things I did was just simply wait for the candle to close, because sometimes it'll turn into just a spike through resistance, and then it'll still close at the end of that 1 hour candle back below. So it was a premature decision, right? I was guessing what the candle was going to look like instead of waiting for confirmation. That was my first mistake. So then I started saying, okay, well, I have to wait and only analyze close completed candles. That helped me eliminate some of the head fakes. But then I was still getting in on the close of that candle when I got the candle that broke out of consolidation, and I was still experiencing head fakes. They would still, this candle right there closed at 1.1971. I used to get in at 1.1971. This is back when I first developed this method in 2001. The next candle right there, the high is 1.1971. So it never went even a pip or even a half a pip higher than the signal candle high. And then it dropped down. So one of the lessons that I learned from a few professionals, one of them being John Bollinger, was that you want to wait for price to take out the high of the signal to confirm that you're trading it in the right direction. That helps with some of the confirmation. So I took that idea and that strategy, and I thought, okay, well, I'm just going to use, initially, you probably heard me say this, a 10 pip range, a 10 pip high, meaning that price had to take out the high of the signal candle by 10 pips, and then I would get in. Well, I knew that I knew that my target was going to be 55 pips because I measured the distance according to the breakout and how far it would travel, considering how far it's already traveled during that day when it created the breakout. So I was factoring all of this in to the daily average trading ranges to determine how far I could expect price to go, because I found myself holding onto these trades too long. I was expecting more, and it wasn't realistic. It was unrealistic. I was expecting more when it wasn't going to go more. There was no reason for it to go anymore. There wasn't enough economic data. There wasn't enough reaction. There wasn't enough participation. It had already exceeded its daily average trading ranges, but I'm sure you already understand all that. So I'm trying to figure out how to avoid these head fakes. So again, I started off with a 10 pip range. I went to 7. I went to 5. 3 pips is what I settled on a few months after developing this method, and I've used a 3 pip entry ever since 2001. And what that means, again, is that if I have a breakout candle like this and all of the indicators confirm, I still cannot get into this trade until price takes out the high by 3 pips. That means if the high is 71, I can't get in until 74. And it never went as high as 74. It only went as high as 71. So I would have never been tempted to take this trade higher. And that's what helps me stay. That's another form or another strategy, another method, another precautionary barrier that I put in front to make sure that in order for me to get into these trades and to expect that it's going to go where I think it's going to go to the 55 pip target, these conditions need to be met. And again, the first one is don't look at or try to analyze an open live candle. Wait until it closes, and then you have confirmation. That's the first step. The next one, of course, I was using on a 30-minute chart, and I switched to a 1 hour chart, and that eliminated some of the head fakes. And then the next one was using the 3 pip entry. This is a perfect example of how that 3-pip entry rule keeps me out of trouble if it turns out to be a head fake. It doesn't necessarily give me an opportunity to sell it right away, but I certainly don't go long, which means I would immediately have lost, or within a few hours, lost 55 pips on this pullback. So the 3-pip entry rule, I put that in place. I developed that. I knew that it was going to work, and it's worked like this every single year. It doesn't matter if it's crisis environments or not crisis environments. It works like this over and over and over again. That 3-pip entry rule that I put in there, that was one of my ways of preventing a head fake from me getting into those head fake moves, and it works. And it works just like this. Sometimes there's a 1-pip move or a half a pip move above the signal candle high, but it doesn't go to the 3-pip entry. If it goes higher and these indicators do not confirm, then I shouldn't be going long anyway. If these indicators don't confirm and then it goes 3 pips or above 3 pips higher than the signal candle, then I'm trading against the confirmation that I have anyway. I shouldn't be trading it anyway. One way or another, there's protective measures in place to prevent you from getting into these head fakes if you're going to use the continuation breakout trade. So it was a continuation breakout trade signal candle, and it was confirmed, but there was no 3-pip entry.